What if some of the most responsible money habits you've built are quietly costing you more than every financial mistake you've ever made? Not your bad habits, your good ones. The habits you're proud of. The ones you mention when someone asks if you're being smart with money. The ones that feel safe, careful, and disciplined. I'm going to walk through 5 of the most common, careful money moves and show you exactly where each one stops protecting you and starts costing you. Not to say throw caution out the window, but because careful and optimal are not always the same thing, and the gap between them is often 6 figures over a lifetime. I'm Mr. Finance, and every week I put real numbers on the money moves everyone talks about, but nobody measures. If you want the next one to find you, subscribing takes one tap. Now, careful habit number 1. Emergency funds are one of the best financial decisions anyone can make. 3 to 6 months of expenses in a liquid, accessible account is genuinely good advice. It eliminates the need to go into debt when life surprises you, and it prevents panic selling investments during a downturn just to cover a car repair. But here is where careful becomes costly. Keeping 12, 18, 24 months of expenses in cash or in a savings account that barely beats inflation because it feels safer. Let's say your monthly expenses are $3,000. A standard 6-month emergency fund is $18,000. Keeping 12 months means $36,000. The difference, $18,000 parked in a savings account versus invested in a simple index fund. Over 20 years, $18,000 invested at 8% grows to about $83,000. The same $18,000 in a savings account earning 4.5% grows to about $43,000. And after inflation at 3%, the real gain is modest at best. The gap, roughly $40,000. Not from taking reckless risks, from holding 2 extra months of cash that you statistically will never need. The rule, 3 months of expenses is the minimum. 6 months is solid. Beyond 6 months in a savings account, for most people with stable employment, you are paying an insurance premium of tens of thousands of dollars over time for a risk that is already covered. Debt feels bad. Psychologically, emotionally, the idea of being debt-free carries a weight that compound interest charts cannot fully capture. And for high-interest debt, credit cards, personal loans above 8%, paying it off first is mathematically correct. But for low-interest debt, a mortgage at 6.5%, a student loan at 4.5%, a car loan at 3.9%, aggressively overpaying it instead of investing the difference is often a significant mathematical mistake dressed up as responsibility. Here's the math. If you have a mortgage at 6.5% and you make $500 extra payments per month to pay it off early, you're getting a guaranteed 6.5% return on that money. That's not nothing, but the S&P 500 has averaged roughly 10% per year over the last 30 years before inflation. Even at a conservative 8%, investing that same $500 monthly while making the regular mortgage payment produces more wealth than the prepayment strategy by a significant margin. $500 a month for 20 years at 8%, roughly $294,000. $500 a month in mortgage prepayments, a mortgage paid off a few years early and some interest saved, typically around $40,000 to $70,000 in interest. The gap favors investing by roughly $224,000 to $254,000. That is the hidden cost of aggressively paying down low-interest debt. The threshold to remember, if the debt rate is below your expected long-term investment return, investing beats prepaying. For most standard mortgages and student loans in the current environment, the math favors investing the difference. The debt still gets paid, on schedule. You just don't rush it. This one is dressed up in the language of wisdom. I'm waiting for a correction. I'll invest when things stabilize. The market feels high right now. I'll start after the election. The feeling of waiting is the feeling of caution. But what it actually produces is missing time in the market. And time is the only input into compound interest you can never buy back. Here is the study that should end this debate. Researchers at Charles Schwab looked at 5 hypothetical investors who each received $2,000 a year for 20 years. The perfect timer invested at the market's lowest point every year. The worst timer invested at the market's peak every year. And the third person just invested on the first day of the year, every year, without looking at the market at all. The gap between perfect timing and worst timing, $30,000 over 20 years. The gap between any of them and the person who stayed in cash waiting for the right moment, $77,000 to $107,000. Being in the market is worth more than when you enter it, almost every time. Waiting for the right time costs most people tens of thousands of dollars. Quietly, with no single dramatic moment where the mistake is visible. The right time was the last time you thought, I should probably start investing. The second best time is now. Avoiding credit cards entirely has become popular financial advice, and for people with a history of overspending on credit, it's the right call. Full stop. If credit cards have been a problem, don't use them. But for people who can pay the full balance each month without fail, avoiding credit cards is quietly expensive in 3 separate ways. First, rewards. A no annual fee cashback card returning 1.5 to 2% on all purchases gives back roughly $300 to $600 per year on average household spending. Money you'd spend anyway, returned to you for free. Over 10 years, that's $3,000 to $6,000. Second, fraud protection. Credit card transactions carry significantly stronger consumer protections than debit cards or cash. A fraudulent credit charge is reversed, usually within days. Fraudulent cash or debit transactions involve a more complicated recovery. Third, credit score. A strong credit score, built partly through responsible credit card use, saves money in nearly every major financial decision you'll make. Mortgage rate, car loan rate, insurance premium, apartment rental. A difference of 100 credit score points on a $300,000 mortgage can cost $40,000 to $60,000 more in total interest paid. The rule isn't use credit cards. It's don't avoid them on principle if they work for you. Cash-only living, for the financially disciplined, is a choice that costs real money over a lifetime. Rewards foregone, protection absent, score stunted. This is the most common trap of all, and it's powered entirely by good intentions. I want to save more before I start investing. I need to feel more stable first. I'll start when I have $10,000 set aside. The savings account grows, but the investment account stays at zero. And every month of delay is a month of compound interest that cannot be recovered. Here is the math on a 1-year delay. You plan to invest $400 a month, starting next year when you feel ready. The market returns 8% over the next 30 years. Your 1-year delay, 12 months of $400 sitting in savings instead of invested, costs you approximately $50,000 at the end of 30 years. Not $50,000 that you wasted. $50,000 in compound growth that never existed. You can't earn it back by investing more later, because the early years of compounding have the longest time to grow. The moment you have a fully funded emergency fund and no high-interest debt, investing a portion of your monthly income is no longer optional for future financial security. Staying in saving mode past that point is not caution. It's costly inaction dressed as patience. Every one of these habits is built on a real, valid principle. Emergency funds protect you. Debt feels terrible. Markets are unpredictable. Credit can spiral. Stability matters. These are not wrong ideas. What they share is a common error. The habit was built for a specific risk and then kept past the point where the risk was addressed. The emergency fund became excessive. The debt payoff instinct applied to low-interest debt. The market caution hardened into permanent delay. Good habits have a context. When the context changes, income stabilizes, high-interest debt clears, emergency fund is fully funded, the habit needs to be updated. The ones that don't get updated become the hidden costs that compound quietly for decades while you tell yourself you're being careful. Being careful is the right starting point. Being optimal is where you go next. 5 habits. Emergency fund, right up to 6 months, expensive past that. Low-interest debt, pay on schedule, invest the extra. Market timing, the cost of waiting is higher than the cost of being wrong. Cash only, works fine until the opportunity cost adds up. Saving before investing, the right order, right up until you're ready, and then move. None of these are calls to be reckless. All of them are calls to look at what the habit is actually costing you, not just what it's protecting you from. Both sides of the ledger count. I'm Mr. Finance. Subscribe if you want more of this kind of breakdown. No shortcuts, no hype, just the full picture. And tell me in the comments, which of these 5 did you not expect to be on the list? I'd particularly like to know how many of you are sitting on more than 6 months of emergency fund right now. I read everyone.